In 2023, as part of the Catalytic Capital Consortium, INP conducted a study entitled Using Catalytic Capital to Foster the Emergence of African Entrepreneurs in Underserved Markets. In this video, we'll highlight some of its key lessons based on our research and experience. Catalytic capital implies capital that is patient, risk-tolerant, concessionary, and more flexible than conventional funding. Catalytic capital is an essential tool to bridge financing gaps and complement conventional investing. INP has been raising and deploying catalytic capital for over 20 years to finance and support small and medium businesses operating in sub-Saharan Africa. Let's take an example to see how it works, and imagine an African SME that wants to expand its business. Raising funds will be its main struggle, as access to finance is cited by African entrepreneurs as the greatest obstacle to their development. Supporting this SME would allow it to structure and formalize its activities, create decent and formal jobs, strengthen the local economy and ecosystem, ease local access to essential goods and services, promote gender equality and women's empowerment, foster sustainable growth and development. This company, targeting ambitious and sustainable development, can be financed by an impact investor like INP, which will usually unlock an equivalent investment amount from others, such as banks or funds. Let's now look at the economics behind our investments, starting with the economic performance of the SME. African SMEs face many challenges, but our experience shows that most of them, with the right support, do perform well economically. On average, a SME will triple its turnover after 6 years of investment. In the first year, we tend to observe a decline in profitability during the structuring phase led by the investor. But profitability recovers and grows over the course of the investment, again 4 times its value over 6 years. From an investor's perspective, well-performing companies do not necessarily translate into a good valuation. Despite good development trajectories, a company's financial value can be structurally limited by several factors that appear when it's time to exit the company. INP has made the choice of being a minority investor and does not seek for control of the company, making exits more challenging. The markets in most of INP's countries of operation are relatively illiquid and have very few buyers, which delays the exit and weaken our bargaining position. At the fund level, 3 main constraints closely related with the business model of financing small tickets in frontier markets limit profitability. The fixed costs of running a fund mean that investing smaller amounts entails disproportionately higher costs than of bigger deals. Operating as a market builder in markets where we are often the first movers, and we need to spend time raising awareness and sharing our equity investment know-how with all members of the ecosystem. Some risks are higher in our geographies: foreign exchange rates, political crisis, regulatory and tax challenges. Financing SMEs in sub-Saharan Africa implies a tight business model. It is not the economic performance of the SMEs that is at stake. Most of them will grow and perform while creating outstanding impacts. But impact funds targeting SMEs face economic constraints that do not allow them to reach the same level of profitability as conventional investors. Today, the financing gap for SMEs is estimated at USD 330 billion. Catalytic capital is very much needed to close that gap. The economic value created locally can justify lower financial returns for some investors willing to have a strong impact. It is arguably the most effective tool to address this underserved market and provide essential, long-term financing, subsidies, and blended mechanisms, technical assistance, financing guarantee. Ensuring that catalytic capital is better directed toward African SMEs is critical to their success, and must be a collective effort to be carried out by the entire SME support value chain. Closing the financing gap for these underserved companies is key to answering the challenges faced by the African continent.